Hello and welcome to Investors Guide. It's a pleasure to have you join us on the show. We have a packed show lined up for you as always. Remember, you can write into us. There's an email ID at the bottom of your screen, and we are now on Facebook, so you can sign up to receive alerts on the show and view our archives. But getting straight to what we have planned out over the next half hour. How much does planning early help your finances really? We're going to talk about that in our portfolio versus portfolio segment. We're also reviewing the UTI Opportunities Fund. And we take a look at health insurance products for senior citizens in the market to find the best one for you and your parents. All of that coming up later on the show. Let me first introduce Dhirendra Kumar, our mutual fund expert and the CEO of Value Research. He joins us on the show every week to answer our questions about mutual funds. Dhirendra, thank you so much for joining us on the show. Let's get straight to our portfolio versus portfolio segment. Today, Ram has written in. He tells us he's 38 years old and he's been investing since he was 26. And he thinks he's picked all of the wrong options for his investments right now. He tells us his monthly income is about 62,000 rupees from his business, and his expenses include school fees for his children. He already has health insurance and a couple of LIC policies. Now, he tells us he owns the home that he lives in, and these are his investments so far: 42 lakh rupees in fixed deposits, 15 lakh rupees in the Public Provident Fund, and LIC policies that he says will be worth 20 lakh rupees in 2019. Now, he's also invested in the Kisan Vikas Patrika of about 10 lakh rupees. Now, his goals are to plan for his children's education and for their weddings, and of course for his own retirement. Now, looking at his portfolio, obviously no equity investments at all in his portfolio. Would you say that's something he should address immediately?
Yes, it is a big missed opportunity for the kind of saver he is, but I don't think he should be embarrassed about it. It's a missed opportunity. But he could have done much worse. One is that he's a very aggressive saver, which is crucial. The other is that he has been conservative. He has been conservative with the available options in lack of understanding, and rightly so. Because when I think of aggressive saver who could have fretted his money away, I think he's much better off, and I don't think he should be disappointed. Yes, there is a potential opportunity loss, which can, and he still has time on his side. He's 38. He still has many years when his investments can work, and I would say that he's getting a lot of realization of his accumulation so far in this fixed income investment he has made or the insurance policy he has bought, and he should wait for those to mature, get that money, and gradually move his money to one or two balanced fund. I would say that our stable growth portfolio, that's the kind of portfolio, and he should choose. It's important for a person of his profile who has been very conservative, who has kept away from equity, and so his selection of funds should be something which will not give him a roller coaster ride.
Then he has told us that his fixed deposits are giving him currently a monthly return of 25,000 rupees. Do you think he should start with that, moving that 25,000 rupees perhaps every month into our stable growth portfolio, into balanced funds?
Yes, till those funds actually mature, those fixed deposits mature. This periodic income, if he should consider that, and this is a good time to be investing. It is important that for a first time investor getting into a couple of few balanced funds, and he will see in the initial phase he'll see the declining value, and which he has never experienced before given his investment experience so far. So that is something he'll have to get used to, and he should just forget about it, should not look at that value on a day-to-day basis. And this 25,000 rupees a month could be a good start.
All right, Ram, that's the advice going out to you. Pick a balanced fund right now. Start off slow with your equity investments, but it will make a difference if you start now. Over the next 10 or 15 years, it will help you beat inflation, and it will help you secure your future. Good luck with those investments. Write back if you need anything else from us. Let's move on now to our hold or sell segment. Well, Shubhashish Roy has written in from Kolkata. He tells us he invests 1,000 rupees every month in the list of funds that he has sent us. He has a 15-year horizon for these investments, and he wants them to eventually pay for his son's education and for his own retirement. Now, this is the interesting part. He wants a minimum of 12% return from these investments. So he wants you to tell him which of these funds he can expect that 12% from and which he should be redeeming. So the first one on his list is the SBI Magnum Global Fund. Hold or sell, rate?
It is a fairly aggressive fund, and of late it has not been doing well. I would say a sell on this fund.
The Reliance Regular Savings Equity, one of the funds that we recommend on this show, 2,000 rupees being invested. Should he hang on and continue investing in this fund?
Yes, this is worth holding.
The HDFC Top 200 fund is the next one on his list. Should he continue investing in this one?
Yeah, this is a clearly a hold, an impressive fund.
Reliance Growth, Dhiren, hang on to this one as well?
Yeah, hang on to this one as well, though it's not doing as well as as it used to, but it's not a disappointing fund.
The Birla Sun Life Dividend Yield Plus is the next one on his list. Is this something that will be able to give him 12% over the next few years?
Yes, this is a fund which actually makes a case by falling less, but among the dividend yield fund, it is not a very impressive one at that. And I would say that there could be superior, better substitute to this fund. So this could well be sold. Of course, this is not the best time. This is the kind of market in which this fund, this kind of fund, the dividend yield funds, really stand out. So hold on for a while and then consider selling.
The HDFC Equity Fund is the next one on the list. There is, of course, that overlap that we keep talking about with HDFC Top 200 and this fund. Should he continue investing in both of them?
If one is investing for this kind of time frame, 12 to 15 years, I would say HDFC Equity will be a better bet than HDFC Top 200.
Reliance Long-Term Equity Fund is the next one on his list. Dhiren, continue investing in this one?
Yes, continue investing, and of course this fund will be disappointing in the near term, and stay put, because here's a fund company which is known for its mid-cap, small-cap findings, discoveries, and I think this is the kind of fund which will be extremely cyclical, will have a long spell of poor performance, and then it will do very well. And this fund actually requires 2 bull runs in its life of 10-year, 15-year holding period. So I would say you should have you should be very patient with such a fund and keep investing.
All right, so he does have 5 more funds on his list. Now these are all thematic funds, and he tells us he's invested a lump sum amount in these funds, but he hasn't told us how much. So I'm just going to go through them one by one. The HSBC Progressive Theme Fund, Dhiren, hang on to this one as well, do you say?
No, I would say that this portfolio is going all over. It is turning out to be a large collection of something something which looked impressive when they were launched, but this fund has not been able to make a case for itself so far. Keep away.
IDFC SME Growth Fund, Dhiren, again another offbeat fund. Should he continue hanging on to this one, or should he just redeem that money?
Yeah, this fund is also doing well, but there are better ways of having these exposure, and he should be in far better control of his portfolio.
He has 2 infrastructure funds on his list next, the Reliance Infrastructure Retail and HDFC Infrastructure Fund. Now, infrastructure as a group have been doing fairly badly as far as mutual funds are concerned. Do you think he should continue investing in these 2, or should he redeem that money?
I think most investors will do will be better off if they pull their money out of the infrastructure fund and get into something mainstream, depending on they get into a large cap fund or a large or mid cap fund. Because those funds actually give fund managers a superior flexibility. Nothing stops them from being and becoming a infrastructure tilted fund when the need be, and those fund managers will not be forced to invest in a defined universe, which is eliminating getting into defensive sectors as and when the need be. So and infrastructure is actually proving to be a big drag, a test of patience for many investors. So I would say investors should consider exiting their infrastructure positions.
Subhashish, that's the advice going out to you. You have a very long list of funds in your portfolio. It might make sense for you to just pick one of our portfolios, growth or the aggressive growth portfolio. Those fund names are flashing on your screen. We'll also email them to you so you can use them to make your investments. Right back to us if you need anything else. On the other side of this break, we're going to talk about the UTI Opportunities Fund, and we'll tell you if you should be investing in it. So don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thanks for staying with us. Dhirendra is still in our Delhi studio, and we're going to review the UTI Opportunities Fund. And Avan joins us like she does every week to give us an introduction into that fund. Avan.
A fund that aims to invest in attractive-looking sectors and exit sectors with negative fundamentals is the UTI Opportunities Fund, our big fund in focus today. UTI Opportunities aims to make the most of opportunities in the market by moving its investments among different sectors as prevailing trends change. Launched 5 years ago, the fund may also take concentrated bets in stocks facing special situations such as mergers, splits, turnarounds, and new product launches. The fund got off to a weak start with an 11% return in 2006, underperforming the category as well as the benchmark, mainly due to wrong bets on mid-caps in a year when the large-cap stocks rallied. To add to its woes, the high sector allocation in autos proved to be a bad call. But the fund has made up on lost ground. Over the past 3 years, it has emerged among the top 5 performers in its category. Some number crunching could get us a fair idea of the fund's performance over the years. If you invested 1,000 rupees in this fund when it launched, you would have 2,647 rupees today. But is this a sound investment? Let's find out.
Thanks, Awad. Whether it's the UTI Opportunities Fund and its investment philosophy in terms of finding sectors that give an investment opportunity in terms of valuation, how well do you think that has worked so far?
It has worked very nicely for the fund, and it has worked very nicely. The execution of this is quite impressive in a sense that finding sector, and the fund has retained its it has been managed in a fairly conservative way, in a sense that the fund has not gone down on the capitalization breakup, its portfolio focus. So this has largely been a large and mid-cap fund. It has spotted some sectors. More importantly, this fund has its claim to fame on a couple of occasions when the market most other funds were caught unaware when the market surged, and this fund was fully invested. So I think that disciplined approach, being conservative, spotting sectors but not taking, still maintaining its diversity, that has worked nicely for this fund.
Its UTI Opportunities had a rough start, we know, when it started off, but then since then it has beat the category average quite handsomely. Where do you see it going from here? What sort of performance do you expect?
Very difficult to guess the performance of this fund, because this is fairly dependent on spotting one or two sectors and getting concentrated, and this fund does not show this fund does not show its aggressiveness. So I would say that I would expect marginal outperformance to its benchmark than a substantial, it does not behave like most other opportunity fund which can take huge bets on some companies or some sectors. It still shows all that in it keeps it in great moderation. So I would expect a marginal outperformance to its benchmark than anything substantial.
All right, then finally, to put it in a nutshell, your star rating of the UTI Opportunities Fund?
A 4-star for its superior risk management and superior good on its risk and managing risk and being above average performance.
4 stars there for the UTI Opportunities Fund. We have one more question for you. Virendra Vishnu has written in. He wants to know, when starting an SIP, is it better to use a fixed monthly date or should he use a variable date on an SIP? Which makes more sense?
Actually, I wish I could have I can explain the whole thought process behind SIP. A lot of people are trying to make some big sense of the SIP methodology. It is no magic. It just fits in our income cycle. We get our salaries every month. We make our you make your mortgage payment every month, and then your savings should get into market every month. And worrying about which days, which specific should you be doing, and worrying about the frequency, that should you be doing it on a monthly basis, weekly basis, or a daily basis, I don't think it makes sense. I would say that even if somebody was doing an annual investment over the next 30 years, that is well an SIP. And the whole idea is that you are able to average your investment. The whole idea is that you should be able to manage your anxiety by periodically investing. The moment you try and time it to make it specific date, that actually nullifies the whole rationale of programmed savings into market.
Right, Virendra, that's the advice going out to you. Remember, pick a date on your SIP that's comfortable for you based on when your salary comes into your account. Don't try to time the market within the month. It might defeat the purpose of that SIP altogether. Write back to us if you need anything else. So moving on, we know that you can get a tax benefit of 20,000 rupees a year if you buy a health insurance policy for your parents if they're senior citizens. But as several of you know and you have written in to us, there aren't too many insurance companies who are offering insurance for senior citizens. So we decided to go out into the market and do some shopping and find the best health insurance policy for a senior citizen. Take a look. Magar and his wife have carefully built their life savings to look after their future goals and their parents' retirement. But a sudden medical emergency threatens to wipe out their entire corpus, because neither of Magar's parents have health insurance.
As you grow more older in age, the reasons to have health insurance, particularly for things like whether it's accidents or it is some infectious diseases for which seniors get into a hospital, or it could be some critical body systems like cardiac or orthopedics for which seniors generally require more hospitalization if you compare their usage with somebody who's younger and healthier.
The problem is in finding an insurance policy that covers his parents who are well above the age of 65, a policy most insurers have been shying away from. So we decided to help in our search through our 4 products that cover senior citizens above the age of 65. The Bajaj Allianz Silver Health, the Max Bupa Silver or Gold that has no limit on the age, National Insurance's Varishta Mediclaim that covers you up to 90 years, and Star Insurance's Red Carpet Senior. But picking a policy requires careful consideration. There are several details to keep in mind. First is the waiting period on your pre-existing illness.
Well, the waiting period essentially says 2 things. Number one, that for any pre-existing illness, you will get cover only after the end of the waiting period. So, for example, if somebody has hypertension, in that case, any disease that comes from hypertension, in a normal health insurance policy, you would probably get cover after 2 years or 3 to 4 years, depending on the product that you bought. But in a senior citizens plan, that would typically be around 1 year.
So here is a comparison of the waiting periods of the policies we're looking at. Max Bupa Silver or Gold waits for 4 years, but all of the other policies wait for only 1 year. The next thing to keep in mind is the premium rates. Each policy will be priced based on the age, health conditions and the coverage amount of the insured person. So let's compare these policies for a cover of 2 lakh rupees for a 60-year-old male. National Insurance's Varishta Mediclaim will cover you for a maximum of only 1 lakh rupees at a price of 4,180 rupees. It's important to remember that some of these policies will also offer you the option of co-payment.
Co-payments, which means that if there is a 100 rupee claim that is eligible, there could be a co-payment of 20%, which means for the 100 rupee eligible claim, 20 rupees you will have to pay, 80 rupees the company will pay. So co-payments are probably going to be a fact of life.
Find a policy also that has the widest network of hospitals. Make sure the policy has a cashless facility at the hospital that you prefer to use, or the one that your current doctors prefer as well.
There are a number of products that give you cashless hospitalization, but there are other products that give you cashless hospitalization only for network hospitals and do not cover non-network hospitals. So either you are very comfortable with the network coverage, and network coverage can change from time to time, or you look for products which can give you coverage beyond simply covering their own network.
So go out and find the policy that suits you best in the terms of age, waiting period and coverage period. Remember to pick a policy that will cover you for the longest time, preferably your whole life. And remember, the earlier you start, the cheaper and more comprehensive your health cover will be. Right, remember, the earlier you take a health insurance policy, the better it is for you, irrespective of what your age is. Go out there and buy that policy today. It will always come in handy. Virendra Kumar, thank you so much for joining us on the show and answering all of our questions. We look forward to talking to you again next week. Coming up on the other side of this break, we'll answer more questions with Vishal, who's standing by in Standard Chartered. Vishal is going to answer questions about your investments, so don't go anywhere. Welcome back. You're watching Investors Guide. Thanks for staying with us. We have a special expert joining us. Vishal joins us from his Standard Chartered office. Vishal, thanks so much for joining us on the show. Let's get straight to our first question. Ashish has written in from Pune. He tells us he's been investing in a ULIP from Tata AIG since 2005. Now, what he tells us is the total premium he's paid is lower than the surrender value that he might get. And as per the policy document, there's no surrender charge after 6 years, which is at the end of this year. Now, he's clearly unhappy with the returns and he wants to know if he should exit the policy now and start investing in something else. What should he do, Vishal?
Say for Ashish, the first thing I'd tell him is that, try not to confuse between the insurance protection need versus the investment need that you have. Now, in this case, it's a bit like, I bought insurance, but I really needed an investment. Having said that, the policy is bought does have very, very low allocation charges. So it's a good investment plan over the long term. But having said that, now that you've run about 6 years into the policy and you're at a crossroad where you want to decide whether to surrender or not, the two things I want to point out. First, in most policies, allocation charges and your expenses are really a bit front loaded. So you've already paid a fair amount for holding on to the policy over the last 5-6 years. So incrementally the allocations come down and therefore the benefit that you get would actually be higher. And therefore that's a point supporting the fact that you should hold on to this policy. However, the second point is actually against. With one policy, you're taking the risk on one fund manager, and therefore if that fund does not do very well or doesn't do as well as some others in the market, then all your eggs are in one basket. So to that extent, I would say that there is a case to really look at surrender value. In this case, the surrender value is not very far away from the actual fund value, so therefore the cost of exercising this flexibility is not very high. And take that money and invest it spread across a few high performing mutual funds. That will give you the benefit of diversification across a few fund managers as well as flexibility should you want to change your fund manager over the next 4-5 years. And that's a plan I think that that may actually generate more returns over the next 5 years more specifically.
Right, our last question comes in from Sanjeev Nayak, who writes in saying he and his wife have a combined income of 20 lakh rupees. He tells us he has a 1 crore rupee term cover, which is very good, and his wife has a 65 lakh rupee term cover. And they also have a couple of investment policies from which they get term covers as well. He wants to know now if he should take a personal accident or a disability insurance because neither of his life insurance policies have those riders on them. So how important is it for him to take a personal accident and a disability insurance policy? Vishal.
Say for Sanjeev, what he is suggesting or looking at in terms of adding personal accident and death and disability riders to his medical insurance is quite feasible. So there are plans in the market where you can add these riders to your health insurance covers. So that is one feasibility for sure. The flip side though is that under most of these plans, the amount of coverage for PA and disability may be at about 25 lakhs or so. So if Sanjeev is looking at a higher cover, then I would suggest that he could go and buy a standalone personal accident and disability cover from general insurance companies. Normally, you will be able to find covers for up to 1 crore from these companies. So the cover is far more liberal in that sense. And the third alternative, of course, is that over time, when he wants to increase his term assurance cover, then he could also look at personal accident and disability as a rider on top of his term insurance. So these are all three possibilities. I think the second one, which is to buy a PA and disability cover from a general insurance company straight away, might be most optimal right away.
Alright, that's a wrap on this show. Vishal, thank you so much for spending time with us. Remember, if you have questions for Vishal or any of our experts, you can write to us at the email ID at the bottom of your screen, or you can catch us on Facebook where you can leave your questions on our page and you can sign up to receive alerts on this show. Thanks for watching Investors Guide this week. Remember, write in with as many details as possible. It makes it easier for us to answer your questions. Tune in next week and catch Investors Guide. Thanks for watching.